How's everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berkowitz. This is the weekly banking update where I ask you to give me 30 minutes and I will try to bring you all the latest and greatest banking news of the week. So, I think we were all kind of just enjoying the summer and the warm weather and everything that was going on. And then CrowdStrike decided to drop a giant turd burger on all of us on a Friday afternoon in the summertime. We thank them so much for that. So as hopefully a lot of people will probably be working over the weekend, this weekend, and I'm sure into next week to solve all of those cyber and operational and network issues as they try to debug that and get things back up and rolling. So we'll get into all that. Well, actually, we won't be getting into all that in this episode, but like I said, we're getting into some other banking news here. But I just very quickly, I wanted to run down with everybody. So here are some other episodes that I posted out this week. Let's get into So I posted up episode 178, which was how to survive a wiperware cyber attack. And it's kind of apropos that we had the whole thing with CrowdStrike, as I just did this whole episode on basically a wiperware attack and basically what are things that you could do to prepare for that? What are things if you unfortunately do get hit with something like that, what can you do to try to clean up thereafter? And I think a lot of the best practices that go along with that and a lot of things that I talk about in there as far as like ransomware, maliciousware, denial of a service attack, all the things that I get into in that episode, from a training aspect and from a best practices aspect, a lot of that stuff relates to what just happened on Friday with the CrowdStrike update and Microsoft and how it affected systems and networks and devices and how, what you could do to try to, just plan to deal with something like that in the future. And then I did episode 179 was what is the new POS digital wallet? And basically, so this is a new app that is coming from technology company Early Warning Services, which also operates the Zelle app and the Zelle basically platform. And this company is basically owned by a bunch of the big banks: JP Morgan Chase, Bank of America, Capital One, PNC Financial Services, US Bank Corp, Wells Fargo. And so they basically own and operate the Zelle app, the Zelle network. And now they're going to roll out this new digital wallet, which is called the PAS app digital wallet. So just again, go check out that episode if you want to learn a little bit more about that. I did kind of episode 180. I did kind of a mid-year economic outlook for 2024, just kind of looking at like, well, where are we at right now in general and what could potentially be coming for the second half of the year. Yesterday on Saturday, I posted episode 181. It was an interview with Chad Hull from Janney. Chad is an investment banker and like I said, very well respected investment banker in kind of the mid-Atlantic region here in the U.S., going from, you could think about kind of like New York down to like Virginia area. And but been around the PA, New Jersey, Delaware kind of banking scene for a long time. Highly knowledgeable and well-respected individual. So if you want to learn a little bit about investment banking, we kind of talk about the market. We talk about what he does as an investment banker. The company he works for, Janney. We talk a little bit about his career. And then as always, I always ask anybody I interview, I always ask them kind of like, what's your favorite business movie? What's your favorite business book? Just to kind of keep it all in a business general, but I like to try to tap into a little bit of that kind of pop culture, scene and trying to terms of like, if you're looking for movies that have a business flair, something that or just good business books in general, I love to relate all that in there. So like I said, go check out that interview whenever you have a second. I posted up earlier. I did a whole episode on the whole CrowdStrike cybersecurity debacle. So if you have a chance, go check that out. I try to, again, I can't really get in depth with solving like major, like, I can't get very granular in the details of solving a cybersecurity issue, but I can at least discuss the issue and talk about like what's going on. And I try to hopefully at least provide a general overview of who CrowdStrike is, how this whole thing happened, what is being done right now. And, hopefully you can find at least a little bit of good information in there in that episode. And then I posted up episode 183, which was an update on the Synapse failure. A few weeks ago, I did episode 157, which called "Is Synapse bankruptcy going to destroy the BAAS model?" So I wanted to get kind of an update on what was happening with that. One of the banks, Evolve Bank and Trust, which is kind of keyly involved in that whole thing. And then basically, what has the regulatory response been thus far from regulators, and the response seems to be, well, you need to put more capital aside to deal with these kind of issues, and you're going to need to have some kind of a breakup plan if a fintech provider were to fail on you, and what do you do with that? So again, go check out that episode, check out those other episodes, and hopefully you will find some really good things and some really good information in there. So okay, so with that, let's get into our banking information of the week here. So what do we got coming up this week? So on Tuesday, July 23rd, we have existing home sales, and we have the API weekly crude oil stock. On Wednesday, July 24th, we get building permits, manufacturing PMI, services PMI, new home sales, and we get the FOMC member Mickey Bowman is going to speak. On Thursday, July 25th, we get initial jobless claims, we get durable goods orders, and we get the GDP, the quarter over quarter. That'll be kind of interesting to see what the GDP numbers are. And then we get the 7-year Treasury note auction. So, and then on Friday 26th, rounding out the week, we get the core PCE price index, which is the Fed's preferred inflationary index. The personal spending, we get the Michigan consumer sentiment, and we get the U.S. Baker Hughes total rig count. So a lot of really interesting economic. We got a little bit of real estate in there with the existing home sales and the building permits. We get a little bit of the job market with the initial jobless claims. The GDP, I think, is going to be very interesting. Like, we've had the GDP has been revised lower. I think we were only hanging out at like 1.4% in the first quarter. So I'll be interested to see what the GDP looks like here. And then obviously the core PCE and personal spending on Friday are going to be highly watched numbers, because obviously is the PCE, if it's down, will that give the Fed a little bit more ammunition to try to cut rates coming up here in September? And obviously people, are keeping an eye on the personal spending as well. So, okay. So now let's get into some of the news. So Fulton Bank, a subsidiary of Fulton Financial Corp., plans to close 13 branches in Pennsylvania and New Jersey by November 22nd and consolidate their operations into nearby branches. The move is part of the bank's strategy and integration of assets acquired and certain liabilities and deposits assumed from buying Republic First Bank from the FDIC. Fulton Bank expects to incur about $10 million in pre-tax costs from the branch closures, but also reduce annual pre-tax operating expenses by about $8 million starting in the first quarter of 2025, according to a regulatory filing. Now, I did do an episode on the Republic First Bank failure, and so it looks like, so far so good. Things seem to be going fine with Fulton Bank absorbing them, and things seem to be going okay for them in that regard. But if you want a little bit more information, go check out the episode that I did on Republic First Bank and the failure there. Bank of OZK is still interested in acquiring failed banks after submitting a bid for Republic First Bank, which collapsed earlier this year. Buying failed banks is Bank OZK's preferred way to grow inorganically, given its history of doing such deals. Chairman and CEO George Gleason II said on the company's second quarter earnings call, Bank OZK did not close the door on M&A more broadly, saying it is one way it can use its excess capital. KeyCorp lowered its full-year loan growth guidance, but said it remains confident it will meet net interest income targets for the rest of the year, drawing skepticism from the street. So a little more additional news on Bank OZK. They believe that getting below regulatory thresholds for commercial real estate and construction loan concentration will be a natural byproduct of its ongoing process of diversifying its balance sheet. So kind of interesting there. Texas Capital Bancshares Inc. is stepping away from low-yielding deposit and loan relationships. The Dallas-based company's deposits declined 1% quarter over quarter as it prioritized cheaper funding by exiting higher-cost relationships in the mortgage finance and broker deposits sectors. It offloaded a total of about $250 million and had mid-single-digit returns. The exit included the sale of about $50 million in loans at par. So So very interesting step there taken by Texas Capital Bank shares. We'll have to keep an eye and see if maybe some other banks follow along this path, but just something to keep an eye on. The credit quality of Bank United Inc.'s office commercial real estate portfolio deteriorated in the second quarter. The ratio of total non-performing loans to total loans was 0.70%, up from 0.48% at March 31st. Much of that increase was due to the office sector, which was not a surprise, executive said. JP Morgan Chase and Company CEO Jamie Dimon believes AI is a valuable productivity tool already impacting the workforce. Business Insider Mexico reported, citing LinkedIn editor-in-chief Dan Roth's interview with Dimon. The CEO of America's largest bank by assets said AI is now embedded in all JP Morgan's businesses and is unbelievable in marketing, risk, and fraud, according to the report. That's very interesting, and it follows on the heels of the House Financial Services Committee's task force on artificial intelligence said the committee should play a leading role in overseeing the adoption of AI in the financial services and housing industries, according to a bipartisan working group report. Well, they better, if they want to do that, they better hop on it, because it seems like, JP Morgan is well on their way. They've apparently embedded AI in all of their businesses, which is fascinating to me. So more to come on that, absolutely, for sure. So Goldman Sachs Group Inc. plans to offer some investment strategies, as it has long reserved for wealthy clients, to customers of robo-advisor Betterment LLC, as the Wall Street giant turns to Main Street investors to boost its fee revenue. The Wall Street Journal reports. Okay, then what else we got here? Federal banking regulators issued final guidance addressing reconsiderations of value for residential real estate transactions. The guidance advises on policies and procedures that financial institutions may implement to allow consumers to provide information that may not have been considered during an appraisal, or if deficiencies are identified in the original appraisal. Furthermore, the Consumer Financial Protection Bureau is proposing an interpretive rule explaining that many paycheck advance products, sometimes marketed as earned wage products, are consumer loans subject to the Truth in Lending Act, so that lenders know their duty to disclose the costs and fees of these credit products to workers. Meanwhile, paycheck advance providers are considering suing the CFPB for the proposed rule, the American Banker reported, citing Dan Kwan, a fintech investor, co-founder and general partner at Nuvcot Ventures, and a former CFPB senior advisor. Okay, let's look at potentially some earnings here. So what else we got here? So PNC Financial Services posted net interest income and margin growth after shrinkage for the past 5 quarters, and the company expects that momentum to continue. PNC's net interest margin grew 1.2% quarter over quarter, while its net interest margin expanded by 3 basis points after the company used the proceeds from the sale of its insurance unit to reposition its bond book, selling $3.8 billion in available for sale securities. Now, I just did an episode on why are banks selling their insurance units, so you might want to go check that out. Service First Bank Shares Inc. stock rose nearly 13% to close at $80.07 July 16th, after the company reported strong loan growth and net interest margin expansion in the second quarter. Service First posted a 15% annualized loan growth from the previous quarter. Its net interest margin rose 13 basis points to 2.79%, as the yield on interest-earning assets is up a strong 16 basis points, while the rate paid on interest-bearing liabilities grew modestly, CFO Kirk Presley said during the earnings call. Let's see here. Morgan Stanley reported second quarter earnings applicable to common shareholders of $2.94 billion, or $1.82 per share, up from $2.05 billion or $1.24 per share for the same period a year ago. Provisions for credit losses for the second quarter stood at $76 million, down $161 million in the second quarter of 2023. Investment banking revenues was $1.74 billion for the quarter ended June 30th, up from a year ago at $1.16 billion. I just find it interesting that their credit loss provisions are down significantly. So that's just interesting. Bank of America Corp reported second quarter earnings applicable to common shareholders of $6.58 billion or 83 cents per share, down from $7.110 billion or 88 cents per share for the same period a year ago. Provision for credit losses for the second quarter stood at $1.51 billion, up from $1.13 billion in the 2023 second quarter. See here. Major U.S. banks, J.P. Morgan Chase & Company, Citigroup, Wells Fargo, and Bank of New York Mellon warned of stress building up among less affluent consumers due to persistent inflation and high interest rates, the Financial Times reported, citing the bank executives' remarks about their bank's lower consumer lending results in the second quarter. So that's kind of interesting as we continue on our earnings here. So Goldman Sachs Group Inc. reported net earnings applicable to common shareholders of $2.89 billion or $8.62 per share in the second quarter, down from $3.93 billion or $11.58 per share in the previous quarter, but up from $1.07 billion or $3.08 per share in the year-ago quarter. Goldman Sachs Group Inc. appealed the Federal Reserve's decision after a stress test to require the bank to hold more capital to cushion possible losses, as the bank would lose more than $40 billion in worst-case scenarios. The Financial Times reported, citing people familiar with the matter, Goldman CEO David Solomon had vowed to engage the regulator to understand the stress test decision, which he said did not reflect the bank's strategic evolution and continuous progress to cut stress loss. Okay. BlackRock reported a record $10.646 trillion assets under management at the end of the second quarter, up 13% year over year from $9.425 trillion. The world's biggest asset manager recorded adjusted net income of $1.55 billion or $10.36 per share in the second quarter, up from $1.4 billion or $9.28 per share in the year ago quarter. BlackRock also booked higher operating income of $1.80 billion and operating margin of 44.1% in the second quarter, up from $1.68 billion and 42.5% respectively a year ago. Yes, my comment is yes, we do need to break up BlackRock. It has just become way too big and way too powerful. Citigroup said it will likely wind up at the higher end of its previous 2024 expense target range of $53.5 billion to $53.8 billion, and unveiled plans to repurchase $1 billion of stock in the third quarter, even with restrictions on intercompany dividends from its primary bank unit after fines over falling behind on work to fix problems with data quality and controls. Wells Fargo and Company stock tumbled after the company unveiled worse than expected net interest income and expense results and provided updates on guidance for both. The San Francisco-based company reported $11.92 billion in net interest income in the second quarter, down 9% from the year ago period and 2% sequentially. It now expects expenses of $54 billion for the year, up from its prior guidance of $52.7 billion. Okay, so I think that's about it as far as the earnings results. But I mean, I think for the most part, I mean, again, banks seem to be doing okay with their earnings. I mean, nothing. I don't think anything. Some problems for sure. Some net interest margin compression continues. Interest rates are still high. Your cost of funding for banks is still high. So again, but all things considered, I mean, nothing too catastrophic. I mean, still dealing with some things in the industry. Obviously, Wells Fargo and Citigroup seem to be having their issues, but J.P. Morgan, Bank of America seem to be rolling along okay. But let's see. Let's continue on with some other news here. So U.S. President Joe Biden nominated Julie Bryn Siegel as a commissioner of the Commodity Futures Trading Commission. The White House announced in a press release. Siegel is currently senior coordinator for management at the Office of Management and Budget, according to a report by Pensions and Investments. If confirmed, Siegel would replace CFTC Commissioner Christy Goldsmith Romero for a term expiring in April 29, according to the report. Goldsmith Romero was nominated by the president to lead the FDIC. Crypto trading platform Abra Capital Management LP acquired several private cryptocurrency trusts from Valkyrie Investments Inc. shortly before it settled with 25 U.S. state financial regulators for operating without appropriate licenses. Bloomberg News reported, citing an email from Abra's head of asset management, Marissa Kim, in response to the news outlet's questions. Valkyrie didn't immediately respond for requests for comments. Okay, so let's move on to a couple other things here. Let me see. All right, let's see here. Same day ACH breaks records in quarter two. There were 8.3 billion ACH payments in the second quarter, an increase of 6.3% over the same time period in 2023, according to Nacha. The value of these ACH payments totaled 21.6 trillion, a 7% increase. So I am going to do an episode on this. I'm going to talk a little bit more about payment systems and the ACH network. And I just did an episode on FedNow, if everybody would like to go check that out. But definitely, more to come on this information. So Basel Committee releases final crypto framework with ICB-backed exclusions. So the Basel Committee on Banking Supervision published targeted amendments to its crypto asset standard to tighten the criteria for certain stable coins to receive a preferential regulatory treatment, which included an exclusion that ICBA strongly backed. So a little bit of detail on this. So the committee did not back down from its decision to exclude assets issued on permissionless blockchains from Group 1 treatment, a position ICBA strongly endorsed in a March comment letter. ICBA agreed that the use of permissionless blockchains gives rise to a number of unique risks, some of which cannot be sufficiently mitigated at present. So obviously, more to come on that. Agencies issue final rule on automated valuation models. So federal financial services regulators formally issued a final rule to implement quality control standards for automated valuation models, or AVMs, which mortgage lenders use to value real estate collateral. So AVMs are used as part of the real estate valuation process and are driven in part by advances in database and modeling technology and the availability of larger property data sets. The interagency rule, which the FDIC released last month, followed approval by its board of directors, requires institutions that engage in covered transactions to adopt systems to ensure AVMs adhere to quality control standards designed to ensure the credibility and integrity of valuations. The agencies want to allow the industry to design and implement systems to determine if an AVM meets these standards. So again, very interesting thing. Obviously, this final rule on these automated valuation models, this is going to have an impact on residential mortgage lending. And again, we shall see what happens with that. Treasury publishes resources for secure cloud adoption. The Treasury Department and the Financial Services Sector Coordinating Council published a suite of resources on secure cloud adoption for financial institutions. So if anybody's out there needs to check in on that, I would go take a look. Industrial production and capacity utilization rise in June. So industrial production rose 0.6 in June and is 1.6 higher than a year earlier, the Federal Reserve reported. The OCC's Michael Hughes stated that we need to end too big to fail. So acting controller of the currency, Michael Hughes, said the growing number and size of large banks is reshaping the banking industry. So speaking in Washington, Hughes said the large banks as a group are likely to have 20 trillion to 23 trillion in assets by 2030, which is roughly the size of the entire U.S. banking system today. He said the nation needs stricter capital, liquidity, resolution, and enforcement standards to ensure the largest banks are neither too big to fail or too big to manage. So no matter how one feels about large banks, simple, dispassionate math provides a sense of scale regarding where we're headed, Hughes said. Last year's large bank failures in particular highlight the need for regulation reforms in areas like liquidity and long-term debt. So here's I agree and I disagree on his comments there. So I agree that we need to I should say this. I don't know if you can fully end too big to fail, because I think banks have just grown to a larger size. I mean, even if a bank that is, 200-300 billion in asset size fails, like the larger regional banks that we saw last year, they were still some of the largest bank failures in U.S. history, and they still proved to be rather difficult to manage and get around. So, I don't know if you can fully end the whole too big to fail threat, but I think we have to do so. I mean, obviously, the question becomes, you've got the big four: Bank of America, Wells Fargo, Citigroup, J.P. Morgan Chase. And you're talking about trillion-dollar balance sheets. I mean, these banks are undoubtedly too big to fail. If one of those big four were to go down, it would be a catastrophic situation for the entire banking industry, for the entire U.S. economy. I mean, the too big to fail thing is absolute. It's absolute. There's no question about it. However, his argument there of basically like the only way to deal with this is through regulation. Oh, well, we just need to deal with this with more regulation. Like, no, I don't think you need to break them up. Like that's the answer. You don't need more regulation. You need to break them up. I think that, Wells Fargo and Citibank, I think in particular, have basically shown that like these banks have become too big and too wieldy. Like I've said for many years, I think Wells Fargo should just be broken up. They can't seem to fully get their arms around all the issues there in that bank and that organization, just because it's too big. And I think you can't. I mean, the only bank that I see so far that has shown the propensity to fully manage and control everything they're doing is JP Morgan. Like JP Morgan really seems to kind of have their hands around everything that's going on there. Okay. But they're, I think, the exception to the rule, so to speak. But I've also said in other episodes too, how big is too big? Like at what point, I reported that, JP Morgan was getting to a point where they're going to start to have, 20% of all the deposits in the US. Like, do we want one bank to control that much? Like, do we want them to have that much, of the market share and the consumer base, the business base of customers in this country? I mean, these are all very important questions that we need to ask. And these are debates that need to be had going into the future. Because like he says here, and he points out, correctly, that these large banks are likely to have 20 to 23 trillion in assets by 2030, which is only another, 5.5 years from now. And that is roughly the size of the entire banking system today. So again, these are debates that need to be had. We need to get, all the bank CEOs together, and not in front of like Congress, but I think these things need to be done where, we should have some kind of industry debates where we debate these topics and talk about like, well, what do people want for the country? Like what would be practical? What will be safe? What will make sense? These are great things to debate and talk about. And so, like I said, we need to have more, I think, a lot more discussion on that topic. So, okay. The ICBA, we have new Federal Home Loan Bank lending restrictions will reduce access to home loans. A recent Federal Home Loan Bank of New York decision to impose new reporting requirements on member banks will restrict access to home loans, ICBA said. So the background. So the Federal Home Loan Bank of New York told its member banks in a recent message that it will impose additional qualitative and quantitative information reporting requirements to align with the FHFA's more restrictive approach to lending, which threatens to restrict access to home loans in local communities nationwide. I have said this before. And like I said here, and it notes in here that a key source of funding, the Federal Home Loan Bank system has worked well for over 90 years, providing community banks with the liquidity needed to fund home mortgage lending and community development projects. Why does the FHFA feel the need to mess with something that's not broken and is not a problem? And I think that's what I keep getting back to. Like, the Federal Home Loan banking system works fine. It's not bothering anybody. Like, why are you messing with it? Why are you causing problems that are going to lead to thousands of banks across the country rely on their line of credit with the Federal Home Loan Bank to be able to conduct business day in and day out, week in and week out, month in and month out? Why are you messing with that? Why are you messing with that? So, All right, let's see here. Do I have anything else? IRS reports problem with crypto tax enforcement. So digital asset seizure values have grown exponentially, topping 7 billion in 2022, but compliance enforcement with virtual currency is difficult. Okay, and I think that's all I got. I'm basically going to wrap up with that. So I would tell everybody. So again, if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. We are on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below, as I always love getting back to everybody. Go check out some of my other episodes. I'm working on some other great things. I got some other great things coming up here in the week ahead. Or I should say weeks ahead. I'm going to be doing probably a couple documentary reviews. I'm going to be doing some book reviews. I'm also got a couple more interviews planned, as well as just, some great topics to come over here over the next couple weeks. So stay tuned for hopefully all of that good stuff coming out. And I will see everybody again next week. Make sure to have a good week. Make sure to look out. I will be posting episodes again this week, so keep an eye out for that. And I will see everybody again soon. Thanks a lot.